The stock market is collapsing, and you should consider exiting. Before Trump ignites a full-scale recession. That's precisely what mainstream media wants you to believe right now. News outlets are blaring economic doom. Social media is flooded with panic, and everyone is asking the same critical question. Should I sell everything before it all crashes? But the reality is far more intricate and layered than these fear-driven headlines suggest. As an experienced investor with years of studying market cycles and financial history, I feel a responsibility to offer a clear and rational perspective. Many of you began investing because of my content, and it's my duty to cut through the noise. Let's pause, breathe, and analyze this situation in depth. Every market collapse has distinct causes. This one isn't random. It stems from identifiable factors, with a central figure threading them together: Donald Trump. Before you assume this is politically motivated, understand that I'm approaching this from an investor's standpoint, not a partisan one. My interest is in safeguarding our investments, not engaging in political debates. Factor 1. Trump's escalating trade wars. Donald Trump has built his image as a master negotiator, the businessman who fights relentlessly for American workers. However, his aggressive trade wars are creating unintended consequences that could rattle not just Wall Street, but also your household budget. Trade wars may seem like a game of economic chess, but historically, they tend to end poorly for everyone involved. Let's revisit 1930 when the U.S. implemented the Smoot-Hawley Tariff Act, aiming to shield domestic industries from foreign competition. It triggered a chain reaction of retaliatory tariffs worldwide, plunging the global economy into the Great Depression. Businesses collapsed, trade routes froze, and millions faced unemployment. Fast forward to today, Trump is reintroducing tariffs in a way eerily reminiscent of that era. In February 2025, he imposed a 10% tariff on Canadian energy imports and a steep 25% on other goods. Canada responded in kind, targeting U.S. imports. Ontario even slapped a 25% surcharge on electricity exports to U.S. states like New York and Michigan. Although initially symbolic, the real escalation came when Trump retaliated with a 50% tariff on Canadian steel and aluminum. These policies sound patriotic, but have far-reaching consequences. As a business owner who imports materials, I know firsthand that companies don't absorb these costs. Instead, prices on cars, appliances, electronics, and even groceries soar as supply chains get disrupted. In effect, the average citizen pays the price while political leaders posture. Moreover, countries like China are proactively forming new alliances, such as expanding the BRICS coalition with Brazil, Russia, India, and South Africa, to bypass U.S. trade altogether. This shift could permanently weaken America's global economic influence. Trump's true motive might not be high tariffs, but rather leveraging them as negotiation tools. At his core, he is a deal-maker aiming for trade terms that heavily favor the U.S. If successful, it could strengthen the American economy. However, his unpredictable approach breeds instability, the ultimate enemy of market confidence. Factor T. 2. Trump's stance on NATO and global security. Another destabilizing element is Trump's repeated questioning of NATO's relevance. He has argued that the U.S. should not shoulder the financial burden of defending allies who don't pay their fair share. While this may seem reasonable on the surface, the implications are dangerous. Weakening NATO emboldens adversaries like Russia and China, who are eager to exploit any vacuum in Western leadership. History shows that geopolitical instability almost always triggers financial market turbulence. War, or the threat of war, disrupts. Trade spikes energy prices and drains national budgets. Investors flee risky assets, and markets plummet. Factor 3. The theory of Trump's hidden economic strategy. A provocative theory circulating is that Trump could be intentionally pushing the market toward a downturn. It sounds outrageous until you analyze the mechanics. Trump detests high interest rates, often criticizing the Federal Reserve for maintaining them. Yet the Fed is technically independent and operates based on prevailing economic conditions. If the market crashes and recession looms, the Fed will be compelled to cut rates drastically to stimulate the economy. This would serve Trump's interests in multiple ways. Firstly, lower rates would reignite growth and elevate the stock market. Secondly, and perhaps more critically, it would reduce the government's astronomical $36.5 trillion debt servicing costs. Think of it like refinancing a massive loan. A 1 or 2% drop in rates could save the government hundreds of billions, if not trillions, annually. Some view this as potentially one of the shrewdest financial maneuvers in modern history, albeit a high-risk one. How you can navigate and even profit from this market chaos history proves that stock market crashes are cyclical, not apocalyptic. They are necessary corrections, clearing out economic inefficiencies. What matters most is your reaction. Panic selling locks in losses. Staying calm and investing strategically turns crises into opportunities. Step 1. Build a financial fortress. Before making aggressive investments, ensure your foundation is solid. Establish an emergency fund covering 6 to 12 months of expenses and eliminate high-interest debts. This will prevent forced liquidation of assets during tough times. Step 2. Start or continue investing. While prices are depressed, the market is currently offering significant discounts. Historically, those who invest during downturns reap substantial rewards. Utilize dollar-cost averaging to invest consistently. Don't try to time the exact bottom. Focus on accumulating assets while valuations are low. Step 3. Diversify relentlessly. Don't put all your capital into stocks. Diversify across bonds, precious metals like gold, real estate, and even emerging sectors like cryptocurrency and green energy. Dividend-paying stocks can also provide passive income during turbulent periods. Step 4. Think long-term. Avoid emotional decisions. Remember, market cycles consist of corrections, 10-20% drops, bear markets, 20-40% losses, and rare full-scale collapses, 40% plus. Each phase presents unique opportunities. Emotional reactions cause most investor losses. Discipline is your greatest asset. Step 5. Monitor global geopolitical trends. Stay informed about global alliances, conflicts, and economic policies. The stock market doesn't operate in a vacuum. Understanding the broader chessboard will give you an edge. Final thoughts. This is not the end of the financial world. It is a strategic inflection point. Those who prepare wisely and remain patient will come out stronger, wealthier, and far ahead of the crowd when the markets inevitably rebound. Subscribe for more insights if you're serious about building wealth in the years ahead. Remember, fortune favors the informed and the prepared.